Is right now the golden opportunity to buy two AI stocks that are incredibly cheap to buy with $1,000. That's what we're going to be breaking out today. So when you look at the S&P 500, so far this year, it's up about 17%, which is kind of crazy with almost no volatility. It has been working incredibly well and as intended from an index fund. When you look even at the trade, the currency shock in Japan, everything that has been going on in the news, the S&P 500 is still performing incredibly well. But when you put it in comparison to companies like Nvidia, the S&P 500 is not growing anywhere near that. We're seeing some of these artificial intelligence companies really trucking and pushing through. So in today's video, we're going to be looking at two no-brainer artificial intelligence companies to buy right now on the dip. First one, of course, is AMD, or Advanced Micro Devices. This is really one of the biggest competitors and one of the only competitors when it comes to NVIDIA and when it comes to the AI data center chips. It is really important. Now, of course, it has some brand new chips that are coming out and they are doing incredibly well, partnering with companies like Microsoft and Oracle. So some of these mega sized companies are going to be using these advanced micro device or these AMD chips, which of course have not only a performance, but also have a cost advantage over the vice versa of the NVIDIA. Now, of course, NVIDIA is looking to launch their next chips, the Blackwell architecture, which of course is going to be faster, but AMD is doing the exact same thing. They are actually launching the MI 350 within the next year, which again, based on the architecture. Now, big company thinking, artificial intelligence thinking, NVIDIA is doing incredibly well. But what about when it comes to personal computers, devices, things of that nature? This is where AMD really does shine. Now, of course, when you look at AI processors on more of an individual basis, it has the fastest chips that are on the market. And of course, releasing the Ryzen AI 300 series notebooks, it is the fastest processor in the industry. That is right. They are number one. Now, these are equipped in HP, Acer, Asus, and a couple other companies. AMD holds roughly 90% share of the AI-enabled personal computers, which is kind of crazy, and they expect this dominance to really continue. When you start looking at the forecast, AMD's data center revenue is up 115% from years ago, up to $2.8 billion, which of course includes $1 billion of sales with the new chip. And when you start looking at the chip itself for the home computers, it is at 1.5 billion, or up 50% from where it was before. So there is a ton of runway that's coming in with this company and really being able to perform. Now, the strength is likely to persist because we know in the foreseeable future, AI is going to be driving an incredible amount of things. When you look at AMD themselves, they've just updated their full forecast for the year to 4.5 billion, which was from 4 billion, with AMD stock down 35% from all-time high. This is really a golden buying opportunity for a lot of individuals. And of course, when it comes to the personal computers, might take a little bit longer to get the chips in there, but if they are dominating the chips, so essentially you have NVIDIA that is going over the big companies, with looking at Facebook, looking at Apple, looking at all of these companies that are going to be using the chips. And then, of course, you have AMD on the other side, which is running with a lot of other large companies. So again, kind of hand in hand, but also focusing on the personal and the individual computer side of it, as well as that data center revenue, which of course, as the demand increases, the revenue is going to increase within these modes because people are going to need that. Now, the second one I haven't heard of, but this is an interesting from this article from MSN. It is Lemonade. So when you think of insurance, when you think of personal insurance, Lemonade is a company that is leveraging AI to shake up renters, homeowners, life, pet, car insurance, all markets across when it comes to insurance, which is huge. So the company is valued at $1.1 billion. So it's very little when you look at Allstate, worth 45. When you look at Geico, which of course is owned by Berkshire Hathaway, it is really making leaps and bounds. It has over 2.1 million customers as the second quarter of 2024. And of course, it's attractive to younger individuals because it is very, very AI driven and very tech savvy. To do this, it has a give back program, which of course a lot of people love. Now, of course, it relies on AI chatbots. This can go hand in hand again with AMD building out some more of those bots, and it is revolutionary, and they are really changing the industry, not only on the insurance side, but also in the AI chatbots that they're using, really quoting and doing everything within 90 seconds. You talk about Generation Z that is really want it right now, want it yesterday. 90 seconds to get an insurance quote, where most people, if you're calling them on the phone, roughly takes 8 to 10 minutes, which is kind of crazy. And that is with no human intervention. So if there's 100 people or 1,000 people, go ahead and quoting traditional insurance can be super, super costly and super time consuming, which of course, younger Americans hate to talk on the phone. And if you are one, definitely let me know in the comment. That is the reason why people are flocking to an insurance company that is reliable, that has a lot of users, and of course, is super user friendly. Now, if you like the content that I'm putting out with the video, definitely consider subscribing to the YouTube channel. But looking at Lemonade, it uses AI internally to calculate premiums to ensure the customer is getting the best possible price, even using AI to detect underperforming products in geographic markets, so management can quickly adjust the marketing spread and really know the efficiency that they're having within there. So they are leveraging AI, they're leveraging technology, which of course it allowed the company to shrink the workforce by over 9% in the past year while growing the insurance by almost 22%. So you're really going and creating massive margins when it comes to this company. Lemonade has recorded $838 million in new premiums in the end of Q2. So the company, nothing to shake a stick at when they're doing almost $1 billion in business. Now, at the same time, gross loss ratio, which of course came in at 79%. 75% is the sweet spot for a thriving insurance company. So that is what they were looking to. Now, Lemon stock is down 90% from its all-time high, which was kind of crazy, set during 2021. This is unquestionably, the company was very overvalued. It had weakness due to a persistent loss of the bottom line. However, the company has really turned around, managed to deliver positive net cash flow for the first time ever, and management believes that can be consistent with the insurance and the product lineup that they're looking for. Now, of course, it isn't kind of crazy because the company is not looking to borrow any money. They are net positive, net cash flow positive at this point. And looking at the price to sales ratio, this, of course, can get mega huge when it comes to these large tech companies. Lemonade is sitting at 2.2, which is near the cheapest level ever since the company came public 4 years ago, which we know 4 years ago was just really the start of the pandemic. So for a company to pull through for 4 years, is it really worth investing in these right now? Honestly, there's a lot of runway with this when it comes to insurance. It is not going anywhere. If they can offer a similar insurance, utilizing and leveraging AI, that is going to make it super efficient and easy to get in this. Now, the question that I have with Lemonade is, what is the effectiveness and how can and when will these larger companies start incorporating the same AI structures that we see with Lemonade? So would Lemonade be a good investment? Looking from the outside, it seems like it's pretty decent. It's turning some profits, could be a good one. But overall, when it comes to technology, when it comes to AI, really leveraging this, I do like AMD out of these two. And of course, with the advanced micro devices, you are looking on both sides of the architecture, having the chips, the structures, things of that nature, as well as the data center revenue. And that is what is driving when it comes to NVIDIA. And in the future, I feel like that is what is going to be driving AMD as well. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about these two companies. And as always, thank you guys for watching. Imagine for a minute making $38 million a day just from an investment. That is really the economics of scale, or really the investing strategy that Warren Buffett has utilized, which we're going to break down in this video today. So a lot of people are kind of wondering, and we know Warren Buffett loves dividend stocks, loves them in the portfolio, and does carry a lot of them. But there are some changes to the portfolio that he has been making. And a lot of people do like following Warren Buffett. A lot of the really big investors looking at Berkshire Hathaway and their massive stock portfolio that they have, there has been some adjustments. And a lot of what they're focused on is really the income factor, which again, when you think of Berkshire Hathaway, when you think of Coca-Cola, they hold 400 million shares of Coca-Cola. They're paying $1.94 in dividends annually per share, which means 776 million is just coming annually from Coca-Cola. That, of course, is not the appreciation of the company. If the value goes up, if the stock goes up, this is just straight what they're giving back to the shareholders. So when you start looking about the biggest investment and where a lot of the money has been moving, Berkshire Hathaway sold $97 billion worth of stock in the first 6 months. So you think about that, we are almost at $100 billion of sales. And a lot of people are questioning where the money is going. And for the time being, it is about a massive stockpile of cash. Now, when we start thinking of cash for you and me, we might think of $100 bills, we might think of money in the bank. They are sitting on a lot of cash, but it is not cash where people, again, kind of realize what exactly it is. They're not sitting on, a giant vault full of money. $234.6 million is held in short-term treasury bonds, and that is where the money is coming from. The rest, of course, is in cash equivalents when you look at money market funds, when you look at different accounts. But when we start breaking in these US treasuries, looking at 6 months or less, this is where the yield is coming up. And as of this article, which of course is today, this is what we're sitting at for the maturities for these bonds. So looking at the bonds themselves, the 1 month is paying a 5.338, 2 months 5.32, so a little bit lower. And you'll see as we start really looking at these bonds and as they start going to a little bit of a longer term, the rate continues to decline, which of course, longer term, the rate should be increasing. But with the inverted yield curve, it's a little bit different. The short-term money is paying a lot more than long-term money, which of course is really evident right here. 3 months, you go into 5.22. 4 months, 5.14, 6 months, 4.94. So the 6 month is not even yielding that 5%. So when you just start looking at simplicity, when you start looking at roughly 5% is about the amount for the yield that they're getting for the cash or cash equivalent that they're in there. So again, thinking of the 5% at the 277 billion they have, you're looking at 13.85 billion, which is kind of crazy, which is what you're getting in dividends. Breaking it down, you're looking at $14 billion annually. This is also equivalent to 1.15 billion every month, or that equates to that $38 billion every single day that the company's making money. So a lot of people wonder why Berkshire Hathaway is not really in a really big and really poised area to buy and make major stock purchases. Right now, with where rates are at, there's not any need to. If you're sitting here and you're making 38 million a day or 1.15 billion every single month, you are happy to hold the cash as you are. So a lot of investors, including myself, waiting patiently and waiting to see what he's going to do, waiting for Berkshire Hathaway, waiting for Warren Buffett. And that's right, they might be even waiting longer until we finish out what is going on with these interest rates and seeing exactly where there are. Business valuations remain super, super high. Now, if you guys remember, and if you've seen the portfolio, liquidated half of the position in Apple, feeling it's really overvalued. He really liquidated a lot of the percentage or the portfolio that he had with Bank of America. So 2 of his biggest holdings, he liquidated, again, $100 billion from those positions. And of course, there's not really a big reason right now for acquisitions, for buying into new positions or buying into new companies when the treasury yields are still paying so much money. That, of course, when you start looking again, the cash hoard that they have, if there is a good opportunity, if there is a big dip in the market, could be a good value to pick up a couple different places. Now, I know he did pick up a petroleum company that he put quite a bit more money in, and he's been doing it kind of on a regular basis. But as it sits right now, they have $277 billion of money at their disposal, that if there was a company that they thought was a really good value, then of course they can invest in it. But this poses the question, and this is what we've talked about a lot of times, what happens when the interest rates fall? So when you're investing in bonds, similar to CDs, similar to savings rates, high yield savings, even looking at the T-bills, when interest rates start to fall and those maturities start coming due. So even now, looking at a 9-month CD, an 11-month CD, a 23-month CD, when the interest rates start falling and they're thinking even 24, we could see an adjustment, 25, 26, seeing an adjustment. That means that when the Fed's fund rate right now, the target is 5.25 to 5.5. So what if in 2 years, this is at 2.5%, 3%? I'm really fighting off inflation, and congratulations. We might have or not had a recession at that point. But when they start going, the rates start going and move very, very closely with them. So what that means for us long-term as investors is you could play the game of holding a little bit of cash, kind of what we're seeing with Berkshire Hathaway, what we're seeing with Warren Buffett, but you could also have the time right now to buy into the market. Now, I know, again, the market is relatively high, but you have to take that really not timing the market, but it is the time in the market, because as soon as interest rates start to fall, what happens to the companies when you start thinking big picture. When rates start coming down, it is a lot cheaper for companies to borrow money. It is a lot cheaper for essentially running the company because things throughout the United States get a lot cheaper. Gets cheaper to borrow money. So when you think of the housing market, when you think of the auto market, when you start thinking of these very large companies, it's a lot cheaper to raise capital. It's a lot cheaper to raise money when the rates start coming down. Now, in addition, with T-bills, again, CDs, all of these rates, money starts flowing right out of those avenues. So there's no reason why a lot of people are going to hop in and be really interested in buying these treasury bills when they get to 2 or 3%. All the money will start flowing back into the crypto markets. All the money will start flowing back into the investment side, the S&P 500, all of these large companies. We'll see a very, very heavy influx of cash as soon as the Federal Reserve starts lowering these interest rates, which again could be as soon as this year. Now, according to the CME Fed Watch tool, investors, they're looking for a total of 2 percentage points by the end of 2025, which is interesting, guys, because right now, if we're at 5.25 to 5.5 is the target, if we're looking at 3.25 to 3.5, it is going to be fire when it comes to the stock market. There are going to be, and again, a lot of money moving right back in there. As soon as the CD rates start going down, as soon as these financial institutions start pulling back on a lot of the CD rates, a lot of the capital that they've been raising through CDs, of course, because they don't want to borrow, making money cheaper to borrow means that the economy is going to fire on all cylinders. And we're going to start seeing these really big companies pulling and really doing a lot more than we're seeing now. Now, of course, this is by design. When you think of Jerome Powell, the Federal Reserve, when the rates start going up, it is to slow the economy. It is to slow and remove the buying power of individuals. And again, that is by design. If you followed anything when it comes to the economy, it is what it is built for, and it is literally riding the waves up and down. We see essentially the rates go down, then we see kind of the peak of where it is. Rates go up, we see the exact same, kind of flattens out for a little bit until the inflation rate or the consumer price index, everything kind of gets to a point. Then we start pulling the rates down a little bit. And again, it's the waves that we're going through in the investment market. And of course, now is the time, in my opinion, to really be buying. So, all right, guys, one crazy investment, yielding $14 billion a year or $38 billion a day with Warren Buffett. Definitely, if you're investing in those T-bills, let me know in the comments and I'll catch you in the next video. When you think of a company with a market cap of $3 trillion, Microsoft fits the bill, but what about the other tech companies that are up and coming? In today's video, we're going to be looking at 2 stocks and the prediction by 2034 that they are going to overtake Microsoft and even Apple as a #1 competitor when it comes to the artificial intelligence space. Now, when it comes to AI, and really the big growth driver for Microsoft has been artificial intelligence. But when you start looking at their earnings and really however they're performing, there are a lot of other tech companies that are absolutely dominating the space that are crushing numbers. And those are the 2 that we're looking at today, which is NVIDIA and Meta platforms. They are booming relative to the adoption of artificial intelligence and really have the runway to outperform Microsoft in the next 10 years. So let's go ahead and break down these 2 that are absolutely going to crush it. And I'm hoping you're invested in them. And if you are, guys, definitely let me know in the comments which one you're investing and what is your percentage that you're putting into these 2 really big growth stocks we're going to see. So the first one, we're looking at NVIDIA. Now, of course, it is currently the third largest company in the world, 2.56. So just a little bit behind Microsoft, but they are catching at an exponential rate. Even when you look up at the valuation over the last 5 years, they have grown by about 2,500%. That, of course, is because of the big center for the graphics processing units or the GPUs that are used in artificial intelligence. And they're expecting this to just exponentially grow over the next 10 years. Now, of course, Microsoft partnered with OpenAI. And if you're familiar with that company, which is a privately held company, they are training ChatGPT, which, of course, the generative AI bot that exploded about 2 years ago. And of course, everybody has been using it. Since then, all of the tech companies have been lining up to buy NVIDIA's AI GPUs, which they are now dominating 80% of the market for those GPUs, which when you think of the other chip makers, including AMD, there's very little to really split that last 20% because NVIDIA does control over 80% of that market. Now, in addition to just the chips, a lot of people don't understand exactly what NVIDIA does and what really their generation for income is going to be. When you start looking at the really data centers are huge, guys. They're estimated they're going to generate $200 billion in revenue the next year with the demand of the next generation, the Blackwell AI chips. And of course, this is a significant jump considering last year they did about 47.5 billion in data centers reported last year. They are anticipated to do 140 to 200 billion in revenue this year, which is kind of crazy when you think of year over year growth and how really big this company is. Now, of course, AMD, to really put it in perspective, is expected to sell 4.5 billion worth of those data center GPUs. You're talking 140 to 200 billion of those GPUs in comparison to the next competitor at 4.5 billion. It is literally light years away. Now, in addition to that, when you think of NVIDIA had the plans that they were going to do a refresh of the chips every 2 years, and they have go ahead and they committed to releasing a new AI GPU every single year instead of refreshing the current lineup that they have, which of course is going to continue this demand for the next decade with the AI chips, and it is just going to get bigger. With an overall market for GPUs expected to be worth $1.16 trillion by 2034. So when again, you think of the next 10 years, it's going to be a almost $2 trillion market that we're going to see if they continue to dominate 80% of that $1.16 trillion market. It's going to be crazy. Even looking at NVIDIA's growth, the annual rate that they're expecting over the next 5 years is roughly 42% a year for the next 5 years, which of course, when you start looking at again in comparison to Microsoft, they are expected to grow around 12 to 13%. So literally you are, tripling up on the growth factor that we're seeing in comparison to holding Microsoft in comparison to holding NVIDIA. Now, of course, they have an absolute huge opportunity to dominate a bunch of different markets when it comes to this. And of course, they're expecting NVIDIA to eventually take over Microsoft's market cap as well as Apple's market cap just because of the growth. And if they stay on that trajectory, they are definitely going to be there. Now, the second one we look at is Meta Platforms. Now, this, of course, is the 7th largest company in the world. So they have a lot more runway, 1.25 trillion that they're doing with this. However, they're quite a distance away from NVIDIA and Microsoft and Apple. However, they have had one of the fastest growth adoptions of AI powered with the advertising tools, which of course go through Meta, which is Facebook. So of course, when it comes to the advertising tools through e-marketing, the digital ads could spend about 13 to 15% in 2024. Now that is one of the absolute fastest growing industries. So very similar to YouTube, where if you have AI that is generating the ads that I want to see specifically, because of course, artificial intelligence as it first grows is going to make a big difference. Now the company's revenue in the first year could grow as much as 24 to 30% to roughly 75 to 85 billion dollars, which is crazy. You're talking almost doubling the revenue forecast that Meta already has. This, of course, is because of the driver of the advertising. Now, they have really seen a massive drive of US advertisers, witnessing a 22% jump in returns with the Meta AI powered tool. So a lot of people want this. Tools, it says, such as Advantage Plus, have been used in Facebook to go ahead and line up the perfect offerings for individuals that are on there. Now, of course, this means that companies are willing to bid a lot more money and pay a lot more money to get those advertisements right in front of you. Now, Meta has witnessed a 10% year over year ad increase impression, and of course, a 10% increase in the average price of the ad. So when you think of the scale of a business like Facebook that is used worldwide, and if they're looking at roughly a 10 to 15% growth rate, it's going to be crazy, because even global digital ad marketing is expected to be a $2 trillion company, or $2 trillion really estimated worth by 2034. So again, thinking of those next 10 years and exactly what it's going to look like. And Meta is expected to deliver 161 billion in revenue this year, which means it will be end the year with a third of the marketing So again, when you think of Nvidia, that is controlling 80% of the marketing. Facebook and Meta is controlling roughly 33% of the digital marketing that is under its control. And they're continuing to gain and really build that market share. Now, of course, when you look at this end market opportunity, it's really a long run. Revenue could increase even further, bumping the ad revenue to up to 40 to 50% of 2034. So again, when you think of that size, if they are controlling 40 to 50% of the digital ad marketing space because of the artificial intelligence that's running, revenue could get to $700 to $800 billion at that point, which of course is 4 times the company's projected revenue that they're really saying they're going to do. And of course, when you start looking at the price to sales ratio of 7, they could see a really big expansion again from the marketing that they have and the artificial intelligence they're running. So when we start thinking of Microsoft, again, being the second largest company in the world, it seems like it is not moving as fast, that it's kind of dragging its feet. Even looking at some of the spending that has been up in Microsoft, even looking at a lot of the sales of Microsoft have been down. It seems like Nvidia and Meta are 2 companies that are absolutely poised to be worth well over what Microsoft is within the next 10 years, especially when it comes to Nvidia. A lot of people ask, is Nvidia a good company to buy right now? My thoughts, absolutely, guys. It's about buying and holding, really looking at the hardware versus the software and what they do have and what they're creating. When it comes to a company as big as we're seeing with some of these mega caps, is it worth holding it in its entirety? No. But being a portion of the portfolio, or even having a portion into like the S&P 500, the VOO, you're going to have really good exposure. And as these companies continue to grow, your exposure is going to stay there within the ETFs itself, which is the reason why the S&P 500 investing, even like the QQQM or something that is a heavy growth ETF, is going to make a big difference in the tech space because they are going to hold a majority of that. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. Retirement can seem very far away when you just started working, but by the time you hit 40, you're considered middle age and you're a lot closer to leaving the workforce than you do have left in there if you're looking at retiring at 65. Now, for most of us, including myself, I want to make sure that I have retirement in place, want to make sure I'm on track, making sure I have a really secure retirement, and really knowing how you do stack up against your peers is going to be huge when you compare it to, guess what, your fellow Americans. That's right, when it comes to the average 401k balances, based on the older Americans that are getting ready to retire, and if you're part of the FIRE movement, you might even be retiring before this. But when you start thinking of retiring at 40, what do the balances in those 401k accounts look like? The average balance in there is $344,000. So when you think of the averages, that is pretty good. When you think of where you're at 40s, you still have roughly 25 years of runway until you're getting into utilizing that 401k money. But the interesting is when it comes to the median balances, which is at 151k. So for a lot of people, there are a lot of smaller accounts that do bring that average balance down. But for a lot of people, almost 50% of Americans, there is no retirement, unfortunately, to speak of at this point. But this is honestly the point where a lot of people do start putting it into top of mind, trying to race to recover, and really missing almost 30 years of compounding interest when it comes to the workforce, when it comes to saving out money. Now, when we get into our 50s, the average balance is $558,000. Median balance on this one is $247,000. So as you can see, again, you're starting to think about retirement. A lot of people are putting more money into those 401k accounts, and the averages have increased in kind of instrumentally have increased. But looking at the 60s, now this is where it gets very interesting. So when you think of the 50s, we're at 558. When you get to 60s, you're at 555. So the average balance of those 401k accounts by the time you reach age 60 has actually reduced. The median balance goes from, of course, in 50s at the 247 to 209. So that means when you're in your 60s, this is the point where people start taking money out of that 401k. So me personally, I am 45. If you think 15 years in the future, that is the point where a lot of people, once you hit that 59 and a half marker, can take a lot of money out of the IRA accounts, a lot of money out of the 401k accounts. And then you get into the 70s. This is where it gets interesting again. Average balance 417 because we're already in retirement and we've started utilizing some of those balances. And the median balance is 103. So when you think from the 60s to the 70s, the median balance goes down almost $105,000 because again, the accounts, especially those smaller accounts, are being used up, they are being closed. So why is there such a very, very big gap between these? It is because the average balances are higher. And of course, it is showing that older Americans are falling short. When you start looking at the median balance, even looking, and I'm sure it doesn't have the data for this, but looking at 70 going into 80, a lot of the median balances are almost to that zero marker because again, people are using this funds. Now this goes right into the belief, Americans believe they need 1.46 million in retirement to recover comfortably. So when you think the average balances is 417, or even before retirement, you're at $500,000, 555,000. 1.46 million. So you're talking, you have a third of the money that the Americans have the expectation to have for retirement to live comfortably. This isn't even looking at, living and really being wealthy during retirement. This is about living comfortably. Now, according to the popular 4% rule, if you're only taking 4% of that nest egg, you don't want to run out of money in 30 years, which is kind of crazy. So if you assume the 401k balance is, of course, that 555,000 at 65 when they retire, that would give you 22k a year. Now, for a majority of individuals where Social Security is 40% of your income, that extra 22 is a little bump with that 4%. And of course, thinking of that, and that is on the average balance is the 550k. So thinking of 22k for the first year, taking that 4%, which means you're probably not going to have enough money. You're going to have to take more than 4%. And even if you look at the median balance, you are looking at less than $10,000 a year that you're taking out of this 401k to use it over that 30-year period. So how can we really combat this? How can we boost those balances in the 401k? Now, of course, if you have money concerns like I do, I don't want any issues. I don't want to run out of money during retirement. But for a lot of people, almost 50% of Americans, they are going to run out of money before retirement is concluded or at the time that they do pass away. So if your balances are falling short, we have 4 steps that you can actually do for the 401k, boosting these up with number 1, making those savings accounts, the 401ks, an absolute priority. If you're funneling money into a lot of other goals, saving for college, even going on vacations, you might want to redirect those funds, even if it is kind of short term. Kids, of course, can borrow for school. You have to have a runway and you have to have time to build wealth. And of course, you can't take loans out during retirement because most people don't have income with debt to income to actually qualify for loans. So it is about investing in the stock market, but building up and buying those ETFs so you can build that nest egg quicker and faster than you ever have before. Now, of course, taking advantage of any help that is available, government subsidies, retirement, really putting in the contributions into your 401ks, into your IRAs, any tax deductible accounts, of course, are going to go ahead and rack up those balances. And of course, if there is a 401k match, this is the time you want to go above and beyond it. If they're offering you 4%, maybe you do 8, maybe you do 10, maybe you're going crazy and you want to put 15 in there because you know during retirement, you're going to need that money. And of course, understanding your goals. If you haven't set your retirement goal, today is the day, guys. After you're done watching this video, you'll need roughly 80% of your salary to live on. That, of course, is a very quick and simple approach. But according to retirement professionals, 80% of it. So if you think about this, and again, kind of breaking down the math in my head, if I'm making $100,000 a year, I need 80% of my final salary year to go ahead and live. That gives me 80K. So out of that, let's say, for instance, Social Security is supplementing about 35 of that. So 35 of my 80K leaves a lot of money on the table. That is going to have to be provided from this 401k. So again, when you think about that 4% rule, you're looking at probably an 8% rule to actually subsidize your income at that 80% marker to actually reach that 80,000, because you're talking roughly a $40,000 gap that you're going to have in retirement. And that is only at 80% of your salary, guys. If you're a high earner, that 80% of course is going to change. The amount you have to have in these investment accounts are going to make a big difference. And of course, my biggest pet peeve, automate the savings, automate the 401k, automate the IRAs. This has to be automated, especially when you start getting to kind of the middle of your life. When you're in your 40s, you have to make sure, because you're very, very likely, or essentially less likely, to miss those retirement contributions in those 401k accounts. And you have to make sure, guys, that you are maxing them out to a point where you can. Anything that you can put extra into these accounts are going to retire, because you also have to remember, when you get to that 401k, when you get to that retirement, it is not really the D-Day. It is not the final day that you are here. You still have estimated another 30 years of growth. 30 years are within the stock market, within those IRAs, those 401ks. They still have the ability to grow during retirement. And the point is to get the nest egg to honestly the size where you don't have to worry about taking out 4% or 6%, because you're not touching your initial investment, and the balances in those accounts are growing faster than you actually are taking the money out. This is, again, a whole thing that we've seen over on Dave Ramsey that was talking about never touching the golden goose, but always taking out the eggs, meaning if I have $1 million in a portfolio, taking my 4% every year, so taking 40,000 out of that year to supplement that 100,000 income that I'm living at 80%, would be about on par if you had $1 million portfolio. And again, if you're thinking about numbers, and Americans are saying 1.46 million, if we're sitting on that 4% taken out of there, of course, going to make a big, big difference. If you can take 60 grand out of there every year, never touching the 1.5 million that you have in there would make a big difference. Now, of course, when it comes to retirement, when it comes to 401k, do not get discouraged with what is going on. You have to be a step above. You have to focus on this. Honestly, there are a lot of misconceptions. I hear a lot of stuff like 401ks are bad, they're evil, IRAs don't work. They work as long as they're invested properly. 401ks, IRAs, investment accounts will do incredibly well in the market over an extended amount of time. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching. When it comes to credit card debt, it's super easy just to swipe that plastic or even tap your card to pay, and that's it. It is completely done. Now, that is evident when you look at the US credit card debt, which is $1.129 trillion in debt already. Now, unfortunately, it's a lot more difficult to get out of that credit card debt than it is getting into it. And of course, looking at the debt, when you start looking at the average credit card interest of 22 to 25%, it is kind of crazy how much credit card debt is eating up the budget in the entirety. Now, as I do financial counseling, we do a lot of restructuring, balance transfers, looking at debt consolidation, looking at home equity loans to consolidate the debt, which is what we're going to be talking about in today's video. The 4 biggest mistakes that I see when people are trying to pay off that credit card debt, starting with number 1, continuing to use the credit card. Now, this is something that is one of my absolute biggest pet peeves. When you're in credit card debt, you're really trying to fight the battle on 2 fronts. If you're paying down the credit card debt and then racking the credit card debt rate back up, doesn't really make a big difference, because then as the rate is running of that 22, 23, 25, I've even seen credit cards north of 30%, which is kind of crazy. It makes it very difficult, because you're almost playing a teeter-totter, where if you're paying $1,000 on a card and then you're freeing up that $1,000, a lot of people do end up spending that back. Now, of course, then when you tack on the interest bill, this is the reason why when it is paying off credit card debt, and if you truly want to eliminate it, the first step in this one is stop using the cards. You have to stick to debit cards. You have to stick to the cash method. You have to stick to budgeting. It is really the only way that you're going to get ahead of the game and being able to really live within your means, which of course is the big part. When you start looking at credit card debt, the big thing here is it is supplementing your income. So for instance, if you make $5,000 a month, you're spending $6,000 a month because that extra $1,000 is going onto credit card debt. That is really a losing game. There's going to be a point where the credit card balances are going to get to a point that they're so high you can no longer cover the minimum payments, or worse, you miss payments. Now your credit score is affected, not only with higher balances affecting the credit score, but of course, as the interest rates continue to go up in a high interest rate environment that we are right now, it exponentially does get more expensive. Now, the second biggest mistake that we see is making the minimum payment. This is the reason why you have to take accountability and look at your credit card and look at your statement. A lot of times it'll say minimum balance to pay, or your minimum payment is $39. If you pay the minimum payment, and this is on the credit card statements, if you pay the minimum payment, it's going to take you 19 years to pay off this balance in the entirety. And during that 19 years, you're going to pay X amount of money. That's right. If you're making the minimum payments on this, it really makes a big difference if you step it up and you're paying more than that minimum. Now, of course, to do this, we recommend one of two methods, which we'll discuss. Number one being the debt snowball. Now, this is the old school debt snowball method, Dave Ramsey. So listing your credit card balances from the lowest balance to the highest balance, and then systematically working from the top to the bottom, eliminating debt as you go. Psychologically, this makes the most sense because you can actually see the elimination of debt as you're paying more than the minimum payment, as you're really consolidating and paying those down. Now, for instance, let's say you have 5 different credit cards. The very first one, as soon as that one is gone, and of course, you're pushing every extra penny you have towards those payments. As soon as that first one is eliminated, you can actually roll that payment down, knocking out the second one, third, fourth, and fifth, and of course, so on and so forth, depending on how many you have. Now, the other methodology behind this is the debt avalanche method. So this does it a little bit different when you're listing them from the high to low. You're not really concerned with the balances, but you're more concerned with the interest rates that you do have on those cards. So if you have a card that is at 30% and a card that's at 20%, that 30% is going to get all of the extra payments, all of the extra money is going to be focused on that one. Once that is eliminated, which it could take you a little bit more time, but when you look dollar for dollar, paying the high interest off first does make sense because you'll be saving the most money. Now make sure when you are making the minimum payment, we are looking for $100, $200, $300 extra dollars. That will cut years off of what you have on the card. And of course, just like in this very first step, you cannot keep using the card. That is really the biggest hurdle that I see in that financial education space, is if you continue to use the card again, it's kind of that teeter-totter method that we talked about, but overall it is incredibly difficult to get the balances down. And of course, guys, if you like the content that I'm putting out, please subscribe to the channel. Let me know in a comment what you guys think, and let's go ahead and get into number 3. That is telling yourselves you'll pay what you can. This is really the approach that a lot of people do, and it's more of a hands-off approach, and it really nullifies or takes away the accountability that an individual can have to pay off and really eliminate that debt. It's a very interesting question, and if you take this to heart, asking yourself, how do you plan to pay off the debt? This is a common question that I ask a lot of people that are looking to borrow money when they have excessive debt, when they do have, high credit card balances. What plan do you have to eliminate this debt? How much can you afford every single month? What can you commit to pay off on this bill? And of course, what does your spending plan look like? What does the budget look like? For a lot of people, they will make that $5,000. They will spend that $5,000. I can make the minimum payment because it's within my budget. I can pay what I can, and that is where it is stuck, and that is where it is left. If you're committing yourself, let's say again, the payment is $39. If you're committing yourself to paying $100 every single month, it is going to make a big difference because that $100 is going to be almost tripling up on those payments, meaning the balances are going to come faster. If you have extra money, let's say your salary, but you get a bonus, you get a tax refund, you get anything, contributing more money to debt is never a bad idea. When you start looking at that 25% interest, that is a guaranteed return. When you're putting more money on there, you're getting a 25% return on that card because you are eliminating debt. Not only are you improving your credit score by putting more money on there, you're helping out your debt to income ratios, and you're really eliminating that debt. Once the debt is gone, you have a lot more money to allocate other places, whether it's vacation, emergency fund, even if it is saving for retirement, whatever it is, you have more money that is available. And the final one we look at, number 4, relying on balance transfers. This is a very, very useful tool, but again, going back to my very first step, it doesn't work for a balance transfer at all. It doesn't work for a consolidation loan at all if you continue to use the credit card debt. Fundamentally, you have to change the spending patterns to change what you're spending on those cards. Now, a lot of cards do have the 0% intro APR. We've seen it for 15 months, 18 months, 24 months, but of course they do come with an upfront balance transfer fee. Now, majority of individuals do have the best intention when it comes to paying this off and really getting rid of it. But remember, the goal that we have here is the elimination of debt. It is living that debt-free journey. It is getting out of credit card debt and not getting back into it. When you start kind of robbing Peter to pay Paul, as a common analogy, you are taking balances from one card to put them on another one, and a lot of people will continue to make the minimum payments on that new card. They're not doubling up, they're not tripling up, they're not staying with the same payments they had on 5 different cards. They are just worried about the one card that they have to make the payment on as it is right now. Credit card debt is a very tough situation, and again, we're looking at almost almost $1.2 trillion in credit card. Now, of course, if you come up with a very good plan, if you put it in concrete, if you start utilizing your debit card, if you start using cash, even if it is short term while you get these credit card balances under control, it's going to make a big difference. And also, if you want to put a runway or if you want to put a really spending plan behind it, makes a big difference. So if you say, okay, I have $10,000 in credit card debt, I want it gone in the next 3 years, 5 years, whatever your time frame is going to be, you can systematically make a plan with X amount of dollars, mathematically looking at how you can execute it and at what point you want that credit card debt to be gone. But of course, that is without using additional credit cards, because when you start getting the cycle and when it does make it super easy, and that's what they do. When you think of using your card, using the tap pay, using the chip, using it online, every place is storing your information. We're in a society right now that makes it so incredibly easy just to pay for literally anything, especially when it comes to impulse purchases, when it comes to memberships, when it comes to subscriptions. You have to keep those in check, guys. It is up to you to really take accountability of your finances like I have, and it makes a difference literally for the rest of your life when you start taking control. So guys, that is going to do it. The 4 biggest mistakes you can make with your credit cards, and I'll catch you in the next video. When you hear the phrase debt is dumb, that leaves very little room for interpretation. Now, of course, other than debt, Dave Ramsey is really against having and carrying any debt, especially when it comes to debt that is good debt and bad debt, just one and the same. Now, in today's video, we're going to be looking at 5 types of debt that are very, very sneaky, because a lot of people view them as good debt or things that you need to have or things that you had to have. But overall, when it comes to the exponential pricing as a financial counselor, I see how much people are paying in debt. Even if you look at a traditional mortgage, taken over 30 years, you're paying for your house about 150% more than what you should be. So if you buy a $300,000 house, chances are you're paying about $750,000 to $800,000 over a 30-year time frame for that mortgage. Now, in today's video, we're going to be looking at 5 sneaky types of debt, according to Dave Ramsey, with starting with number 1, which is a mortgage. Now, taking out a mortgage to buy a home, this of course can be viewed as good debt, but it is also how you do it. Mortgage is debt. It comes with an interest rate. It comes with a very, very significant impact, and probably for you and I, the largest purchase that you're ever going to make. And of course, when it comes to this, 30 years is the traditional mortgage that we're seeing. Most people are not putting money down. Most people are taking a 30-year mortgage. So they are going into a home that is far more expensive than they can actually afford. A lot of times based on income, we know it's capped at 50%, which means your debt to income ratio cannot exceed that 50% part. Now, to really make this a lot more cost efficient, Dave Ramsey focuses on putting that 20% down, which is a very significant down payment. If you think of that home again, thinking of that $300,000 price tag, that is putting down $60,000 on that house. And of course, right there from the down payment, you have built-in equity right up front, which means it's not going to go underwater even if you see a 10, 15% dip in the market, because you had that 20% down. Now, the other part he talks about in this is a 15-year mortgage that does not exceed 25% of your take-home pay. Notice that is not the gross pay. We are talking about the take-home pay. That is not excluding that or exceeding that 15-year mortgage. Now, I don't know about you, but when you start looking at a $300,000 house with a 15-year mortgage, even at today's rates, your payment is probably going to be north of $3,000. And for a majority of people, that is going to far exceed that 25% of take-home pay, which means you got to shop about the $100,000, $125,000, maybe $150,000 range at a 15-year mortgage to even fathom putting this really into perspective. When you start looking again, mortgages are considered good debt because if you don't have a mortgage, you're probably paying for housing in some other method. If you're renting a house, if you're renting an apartment, if you're really looking at a lot of different places, you have to have money to live, to essentially have a roof over your head, which we know is a need, but it also depends on what kind of level you're doing it. Are you buying the starter home when you're starting out, or are you over purchasing and really over committing to be house poor, which of course is a very common phrase that we hear when it comes to really having and managing the debt load. Now, the second one we look at is a car payment. This is where it gets crazy. Car payments, very similar to mortgages, are unavoidable for their entire part but it doesn't mean that you have to spend, what we're seeing right now, $54,000 is the average price tag of a brand new vehicle. You could buy used, you could buy something a couple years old, something with a little bit more mileage. That, of course, is not going to wreck your budget when you start looking at these higher car payments. In addition, when you start adding on the maintenance costs, the gas costs, and the insurance costs, the payments are getting super, super high. Now, of course, with a brand new vehicle, when you drive it off the lot, 15 to 20% of depreciation takes hold. So again, if you're buying that $60,000 vehicle, you are losing a very big price tag and a very big retail sale out of that vehicle when you drive it off the lot. As you continue to add more miles on it, it is of course going to depreciate much faster. Now, of course, when this looks at two people, so let's say it is husband, wife, it is spouse, partners, whatever it is, if you're looking at two car payments, you are just literally doubling everything that you have. And again, financial counseling aspect in me really kicks in because I have seen people that are spending north of $1,500 a month to drive two new vehicles, which again is kind of crazy to think. $1,500. Then you throw in your insurance that you have on those vehicles, you're at about $1,900. So you're dropping almost $2,000 when you put in the maintenance and gas per month just to have vehicles. Now, of course, you could look at a car, let's say the $15,000 to $30,000 range, which would cut your bill in half, or even like we do it, is only having one car payment at a single time. So if you kind of get in sync where someone's willing to drive an older model car or something maybe that might not have all the new bells and whistles, all of the new technology, because of course, you can make a really big difference when it comes to the car payment and find a really reliable car for about $15,000 to $20,000 without a huge price tag. And of course, when it comes to car payments, we've seen people starting taking them for 5 years, 6 years, 7 years. Now we have even seen places that are doing 8 years and places that are even doing 10 years when it comes to an auto loan. I'm sorry, but me personally, if you're doing an auto loan for 10 years, the depreciation is going to absolutely wreck you. In addition, when you're putting miles on there or when you go to sell it, it's going to be crazy because most vehicles are not lasting that 10-year time frame that we're talking about. Number 3, we get into student loans. Now, student loans, of course, $1.6 trillion is what we're looking at the student loan bill currently in the United States, which is kind of crazy. College is expensive, but of course, it can open the doors, it can open the careers, but of course, student loans can be very sneaky. Now, the reason for this is the multitude of years that you have them. So if you're going in there and you're doing, let's say, a 4-year degree, let's say you get your master's at 6 years, doctoral at 8 years or plus, those student loans are running interest the entire time you're in school. So if you borrow $100,000, chances are you're going to be looking at $130,000, $140,000 when you get out of there, which is kind of crazy. The average 4-year college tuition cost is just over $45,000 for in-state and $117,000 for outstate, according to College Board's most recent trends. That's what we're looking at. So in-state is literally pretty much like 40% the cost of going out of state, which of course makes a big difference. Now, when you start getting your career off the ground, when you land that job after you get that 4-year, 6-year degree, is it going to be worth it? And are you making enough to repay those student loan debts? Because again, the interest has been running the entire time. This is one, the next one that we look at is credit card rewards. And this is one that Dave Ramsey and I are kind of on the same page. When it comes to credit card rewards, a lot of people think they're getting it over on the financial institution if they're paying it off every single week, every single month, whatever. When you start looking at the reality of it and breaking it down systematically, even looking at what the government resources have said, consumers spend more money on credit cards than they do with cash, period. If you're using a credit card versus a debit card, you're spending more money. The realization is in our minds, in the way that it is seen, credit cards are not viewed as cash and credit cards are not tied to actual money that you have. So there is almost a psychological factor, which this is from the Federal Reserve of Boston. It's the Diary of Consumer Payment Choices, showing that average cash transactions are $22, average credit card transactions are $57. So subconsciously, without you even realizing it, you're spending more than you normally would on a credit card because, again, most people are justifying the spending and, of course, the impulse purchases, the online, it's in a mobile wallet, it's a tap pay card. But the justification for this comes in with the rewards that are provided from the credit card companies. It's a very sneaky way, of course, to go ahead and get this into the payment process. And it's a way that almost we have psyched ourselves out or really tricked ourselves when it comes to the debt. And the final one we look at for the 5 sneaky types of debt is the interest-free loans and the pay-as-you-go loans. That's right. A lot of people see interest-free and ding ding, they got the furniture. They're buying whatever they want to. They are not paying any interest. However, the caveat to those interest-free loans, some of those have upfront fees. While they're not charging interest, they are accruing interest. And you have to realize this. We see it a lot of times, again, when you're looking at your Gardner Whites, your furniture stores, but also when you're looking at Best Buy and a couple other ones that are kind of the pay as you go, where if it is not paid off in full at a certain amount of time, you accrue interest from day one. So the chances of you actually paying and manage off that debt, if you're paying it over 12 months, are very, very slim. And that is why these companies offer these types of loan. They get you in there, they sell the product. Not only that is they're giving you essentially free money up front, but it's not technically free because again, the interest is continuing to run. Now it is estimated right now that there are hundreds of thousands, if not millions of dollars out there as the pay-as-you-go loans, or some of the loans that are the short-term paying over 4 months. When you look at companies like Affirm, the buy now, pay later, a lot of those companies don't report everything because they are very, very short-term loans, just like what we see with those payday advance or the cash advance loans. Very, very really kind of absorbent amount of fees that come with it, but it's kind of silly when it comes to the amount of debt that we do carry. So, all right, guys, so that is going to do it for today's video. 5 sneaky types of debt that will definitely be there. Let me know in the comments if you have any of those types of debt, and I'll catch you in the next video. One decision away from a totally different financial life. That's something I actually heard a little bit earlier today, and it rings true in this video. Now, learning from the best, very, very good, smart advice. When you start looking at the 1%, there are things that they do that other people do not, really setting them apart, and wanting to improve your finances can be one of those. So in today's video, that's exactly what we're going to be looking at. Some of the things that really the top 1% of individuals do and how it makes a difference when it comes to your financials. Starting with the first one, they do not overspend on vehicles. Now, being a financial counselor, this is one of the absolute biggest things that you think. When you really look at self-made millionaires, they buy cars outright. Now, it's not the Ferraris, the Maseratis. It is not the super expensive cars. But if they do buy more expensive cars, they pay for them in cash. They buy them outright. In addition, they are not overspending for these cars, and they keep these cars for a lot of time. Now, for this case, I'm going to use myself. So we bought a vehicle. Car payment was roughly $600 every single month, and we took that loan out for 75 months. So thinking of 75 months, $600 a month, not only the interest that would be accumulated at about 6.5%, but that also removes and takes away the ability for you to invest that $600 a month. Of course, for me personally, again, doing the financial education piece, we paid it off in about 16, 17 months. And we started putting that $600 into an investment account. And of course, we buy used. This is one of the absolute biggest fallacies that we see. When you start looking at the cost of new vehicles, you're talking north of $50,000 is average. Then you put it at 7%, you're looking at $600+ for an average payment on a vehicle. If you're looking for a vehicle that's a year or two old, let's say 15, 20,000 miles, still has a lot of value, but a ton of the depreciation has already been assessed to that vehicle, meaning that you're not going to be stuck with that depreciating asset because a lot of the depreciation when you drove it off the lot or whoever bought it first is going to be there. Now, of course, the general rule of thumb is 10% of your take-home pay. That is something to note. Now, it is not your net pay. It is the take-home pay. 10% of that should be your car payment. Now, of course, overspending on cars is one of the absolute biggest money mistakes that we make because when you start looking at that, it's giving you less money to save. It's giving you less money to invest. It's also giving you less money to really repay if you have any debt. If you're taking and you get an expensive car payment, chances are it's going to be negative equity. If you're buying a new vehicle, it's very hard to get out of it as well when it comes to overspending on vehicles. And this is a part that we can really control. When you start looking at some vehicles, let's say $20,000, $30,000 range, you can finance them over, 6 months, making your payment affordable because you also have to remember when you have that car payment. So let's say, for instance, you have that $650 car payment, chances are $150, $250 is going to be insurance. Now you're looking at $800, $900 for a car payment, depending where your payment and your insurance do land, which again is super expensive. People are not driving as much as they used to, and we've really seen this. Second one in here, they invest in the stock market, not knowing and really thinking when you start thinking of the 1%, savings is not enough. And I really do stress this on the channel. When it comes to money, it is a depreciating asset. It is going to be eaten up from inflation. Money is meant to be invested. Now, of course, with inflation, it is going to gradually lose value. Building your wealth, it has to be put into assets, and it has to be put into assets that increase value. That is the reason why the investing, and me personally, I really focus on building out those ETFs, looking at your S&P 500, the VOO, looking at, the QQQM, looking at the HD. Anything like this is going to have an asset, and it's going to be an appreciating asset, and it also is going to pay you passive income. It's kind of a win-win-win when you get to the point of being able to invest and being able to invest a considerable amount. Now, when you start looking at the stock market, kind of big picture, averages about a 10% per year. Now, of course, can fluctuate year to year. 2022, we've seen a down year. 23 and so far in 24, we have seen an up year. So the average across that S&P 500 is about 10%. So literally, if you're putting money in there on a consistent basis, even just investing in the VOO or the spider funds, just investing in the S&P 500 index itself, which is a huge popular option, you can make a almost pretty much guaranteed 10% return. And I say that with a grain of salt because it's not guaranteed, but over the long term, it is roughly 10%. When we look at the third one in here, plenty of money in the emergency fund. The emergency fund is really the method and the logic behind what I really focus on. Number one, of course, is the emergency fund. Could be a car accident, a medical issue, job loss. There are so many things that you could go into debt for an emergency, which we do not. We do not want you to get high interest debt, staying away from the credit card, staying away from the personal loans. That is the reason why the emergency fund is really in place before you start doing anything. Now, for a majority of people, they say generally 3 to 6 months of living expenses. For me, I say it's kind of dependent on your job. If you have a job that is in very high demand, you're pretty well set. I would probably stick more to the 3 to 4 months. If you have a job, let's say that's seasonal based, that might be sales based, a lot of things that could be affected by the economy, or if there's a downturn, I would probably look to 5 to 6 months, or even more depending on that situation. And of course, this has to be one of your savings goals. It has to be one of the very first savings goal. If we turn back to Dave Ramsey and the baby steps, first he says emergency fund of $1,000, which is a starter emergency fund or a baby emergency fund. And from there, doing the debt repayment. Now, of course, my take on that is definitely getting first and foremost, if you have a 401k employer match, which we'll talk about in just a minute, getting that, then looking at the emergency fund, then going right into that debt repayment phase. Of course, when you're eliminating debt and when you're paying it down, it is going to give you the ability to invest more money, save more money, make more money buying assets than you are paying down the debt. Now, of course, the next one we look at, tax advantage opportunities. When you start looking at those 401k plans, when you start looking at those IRAs, they are the game changer. I know a lot of people, social media, looking at TikTok, Instagram, even YouTube, a lot of people out there say that 401ks are a scam. They're a sham. IRAs are a scam. They are investment vehicles for retirement. Now, of course, there's a multitude of places, but when you start looking at wealth, over 90% of self-made millionaires are investing, and these tax advantage accounts are no different. So if I'm putting in, let's say 5%, my employer is matching 5%, I am automatically getting 100% return on the money that they're contributing, which makes a big difference. Then you couple it with saving money, putting it into IRA accounts, even doing backdoor IRAs or doing Roth IRAs, which I really stress. Getting a Roth 401k, getting a Roth IRA is not going to give you an upfront tax advantage, what you see with the traditional products. But when you start looking at the Roth and when you start thinking of the big picture of a financial retirement and a financial plan, the Roths do make sense. And I really do stress and push them for everyone that I'm sitting again with that financial counseling and the education piece. The Roth, of course, you're going to pay your taxes up front, but then when it comes down the road, when you're looking at your 10, 20, 30, 40 years of growth you're seeing in these big retirement accounts, you do not have to pay taxes when you take the money out, which is a game changer for the rest of your life. And of course, the final one that we kind of touched on a little bit, avoiding bad debt. When you think of debt and taking on debt, there is really good debt and there is bad debt. I don't like breaking it up because that seems like it is super simplified. But when you start thinking of big picture, you need a place to live. You need a home, whether it's an apartment, whether it's a condo, whether it's a home, you have to have a place to live. There is going to be a place and probably a time for a majority of us where we don't have the ability to buy a home just with cash. you're going to need a car. But this is where it comes a little bit different, because are you buying a $20,000 car that is going to get you to A and B? Might not be super expensive, might not be super flashy, making that payment affordable and giving you the ability to repay debt or to invest the money. Or are you looking at a car that is $70,000, $80,000? That is going to strain your budget, not only for the payment itself, but also looking at the insurance. And of course, again, when you start looking at debt, even looking at student loan debt, as much as I don't like student loan debt, if it is going to put you in a better position for the rest of your life by borrowing money to go to school, getting an education, getting a degree, essentially advanced careers, that is going to be a game changer. And I would really take it as good debt. When you start looking at bad debt, that is the total opposite, which of course the big focus here is credit cards. When you start looking at the average credit card debt, it is roughly about 25%, which of course is guaranteed that you're going to have to pay that 25%. That is where it is the game changer. If there was an investment out there that would guarantee me a 25% like what we're paying on credit cards, it would 100% have everyone in the world investing in it, because of course there are no guarantees except that you're going to have to pay this credit card debt. And of course, once you get rid of this, there is no long-term value to holding this debt. You don't get any benefit. You're not building an asset. It is absolutely the worst thing to do. All right, guys, just a couple money habits that the 1% really focus on. So let me know in the comments what you guys think, and I'll catch you in the next video.